Welcome to World of Short Selling, a podcast focused exclusively on what is happening in the short selling space. Who is short, what and why? Tune in and find out. Today, I would like to warmly welcome everyone to an interview with Jeremy Raper, private investor with buy-side experience who manages an active short selling book. In this interview, you will learn about Jeremy's credit approach to short selling, past stories forming this investment philosophy, what he learned from shorting Tesla, and which short target he now likes the most. Before we start, I would just like to remind you that all you hear on the podcast are opinions. I am not registered investment advisor. Please do your own due diligence. Short selling can hold risks that are different to going long, especially when it comes to Tesla. You should assume that we're short the names we discuss. So without further ado, I would like to welcome Jeremy Raper. Thanks for accepting the invite.
Thanks, Jan. It's good to be here.
Great. I appreciate you coming on the show. So let's start with a relatively straightforward one. How did you start with short selling?
Sure. So, look, I have had a lot of experience as an investor, having worked on the sell side and the buy side for, close to 15 years. I guess I started short selling as an individual investor because my career evolved towards more of a credit mentality in the market. So what I mean by that is, look, the vast majority of equity market participants, they just buy stocks, right? They view stocks as options on the growth of a given business, right? Which you should, because, you buy shares in Google, you spend $100, the most you can lose is 100, but Google keeps growing for a decade. It could be 1,000, could be 2,000, whatever, right? So most equity owners' mindset is very much growth and doesn't really think about, the downside, right? It's just, a minimum amount of risk for potentially unlimited upside. Whereas if you're a creditor to Google, right? So just you continuing that analogy, if I lend $100 to Google, the most I'm going to get back is my $100, whether it grows, to the moon or not. My upside is getting my money back. And if I'm lucky, a coupon. Not even a coupon these days, right? Given where interest rates are. So sure. If your mindset is that of a creditor, you actually don't want growth. Growth costs capital most of the time, right? Unless you're a very capital light business or you're some service business where you're getting paid to grow, like Amazon or whatever. But the vast majority of businesses take capital to grow, and that capital comes out of someone's pocket. And if you're lending the company money, effectively that means you have less of a security blanket, right? You have less assets in the pot covering your claim. So because through, early on in my career, I worked in Japan on the sell side, doing mostly credit derivatives, right? So I was looking mostly from a creditor's perspective at, distress situations in Japan and in Asia. And first and foremost, I was thinking, okay, how do I get paid back, right? What's my downside protection? What's my margin of safety, if you like? So that creditor's mentality kind of naturally lends itself to being more skeptical. And so it evolved very quickly from then. Well, if you're looking for, long securities to get long things where you have a huge margin of safety or where you can underwrite the valuation, even if A, B, C, D outcomes happen and they're not great for you, you still think you'll be okay, which is essentially a creditor mentality, right? You want to be covered in any adverse scenario, buy security, collateral package, whatever. Then the corollary of that is if you find situations where, you think it's a terrible business and or it has too much leverage on it and or you can do the credit work, so there's some kind of credit catalyst, that would probably be a great short. So my kind of overall investment philosophy, look, this applies to long as well as short, but it's what I called credit-based equity investing, thinking like a creditor, but applied to stocks. And, explaining that on the short side is actually extremely easy. As I said, if you have this credit mentality, then you're kind of well positioned to analyze an entire capital structure. So not just the equity piece, but the entire capital structure. Look at all the claims set against the assets of the given enterprise, right? So not just the equity portion, but what other claims there are, whether that be secured debt, whether that be convertible pref shares or mandatory prefs or whatever, or minority interests. And then try and figure out, okay, does the underlying economics of the business support the true cost of capital implied by the liability side, both the debt and equity, right? I mean, without diving too deep into the weeds, the whole genesis of this approach is from, I worked in Tokyo for 4 years between 2008 and 2012. And, the whole genesis of this approach was seeing company after company after company where, the bankers would lend to them at stupid low rates for years, 50 basis points, 1%. For companies that were, levered 5-6 times, burning cash, competing against Chinese companies with much lower costs of production in commodity markets, and running up huge debts essentially in crappy businesses. Everything from airlines to industrials to electronics. Like, we could go through names, but the banks would keep lending to them at stupid low rates, and so you had this narrative where equity market participants were pretty much bullish because they said, "Oh, look, cost of debt's only 50 basis points. It doesn't matter how levered they get. That's free money, right? So eventually they'll turn it around, and then this thing can boomerang, right, because of the leverage." But every 2 years or whatever, the banks would tap these guys on the shoulder and say, "Look, you need to raise money. There's no equity cushion here." It's been massively dilutive equity offering after equity offering. So this was basically a pattern. Every mid or large scale equity recapitalization in Japan went through this pattern, whether it was an airline, whether it was a consumer electronics company, whether it was an industrial company. Basically, as soon as you get over, say, 2 times debt to assets or debt to equity, let's say, because a lot of these companies weren't really making any EBITDA or much EBITDA, so it's much more important to look at the debt to equity or debt to tangible equity. As soon as you cross 2.5 times debt to equity, it's almost inevitable that the equity is going to be massively diluted. So that was kind of the genesis of the approach, right? If you think like a creditor rather than as an equity investor, you can see that even if the business turns, and often they don't turn, but even if it turns, the benefits of that turn would never accrue to the equity owner at that time. It would accrue to the creditor in the form of dilution, right? So essentially what you see is out of court restructurings, right? Recapitalizations happening, over and over and over again. And so, look, I've kind of dragged on, but I think the analogy to what we see at the moment worldwide in developed markets is pretty clear, right? So we have Japan-like credit conditions in much of the developed world, and we have Japan-like risk appetite in much of the developed world. So it's not to the extent of Japan, to be fair, but places like Europe, we can talk about some examples where you have really crappy companies with a large amount of leverage. The debt trade, 1% because there's no debt to buy. The ECB.
Yeah. I mean, you can. Yeah. I mean, I think Greece at 5% or whatever, 4% is. I mean, that's a country, okay, slightly different, but still same logic. So
Greece isn't a bad example. You could put Argentina in that bucket as well, right? They sold a 100-year bond 18 months ago at par, right? That bond is now trading 40 cents, 30 cents. Obviously that's an emerging market, so it's a bit different. But I mean, we can talk about a company like Kali and Salz, a company that I'm short. Okay, so it's a German mid cap, 2.5 billion euro market cap, listed on the DAX, covered by 15 analysts, well covered, trades $20 a day. It's got 6 turns of leverage. They make potash, pure commodity product. They're the most expensive potash producer in the world. They haven't generated free cash in 5 years. They got a massive maturity upcoming. They have been forced to effectively shut production in the last 3 to 6 months because the potash market is just massively oversupplied. Why is the potash market oversupplied? Because there's a lot of guys who've been bringing on production, and when the cost is $100 a ton, the price is $280, $300 a ton. And these guys' price production is more like $200, $220 a ton. So they're the high cost producer, massively levered, big bond maturity coming up in 2021, 2022. And there's the elephant in the room is BHP might go ahead with a massive new greenfield expansion in Canada, which if that's the case, it would add not overnight because it would take 3-4 years to come online, but within 3-4 years, the global potash market would expand by 15-20%. This is a market where demand grows 2-3% a year. So obviously the price would remark massively lower if that happens. Look, this company's debt trades at 1.5%, right? So and it's rated double B. This is a solid junk issuer, right? So why does this opportunity exist? It exists because of the ECB and because the German banks and coverage are pretty lackadaisical. They're pretty relaxed, but there aren't too many worlds where there are many worlds you could see where this equity is fully impaired, right? If a good potash producer, so Nutrien or Mosaic, let's say, they trade at 7-8 times EBITDA. If this thing has 6 turns of leverage and maybe another half turn of pension obligations and remedial obligations, mining obligations, that is, it's not a stretch to see that this equity is not worth anything if the market doesn't turn in the next 12 months. So that's this is a European mid cap. This isn't a micro cap. This isn't off the beaten radar. They have as I said, 2.5 billion euro market cap and over 3 billion of debt, right? So it's a decent issuer. These kinds of things are out there. And as I said earlier, largely because of the global macro conditions and central bank easing. And it's not just a Japanese phenomenon. So those are the kind of things I look for. And back to your question, that's kind of how I started shorting. So basically in 2013, 2014, having worked in Japan and worked out that this was a sustainable edge, right? So people thinking like a creditor, but applying it to equities, not to fixed income. Not a lot of people were doing it, either the long or the short side. So I thought it was kind of a sustainable, or at least something different, right? Not unique. Nothing's unique, but let's say it was a bit differentiated.
And how did it evolve? Like, how did it evolve over time? This focus. Was it just really that you saw what is happening in Japan, and you kind of took it, and it was a kind of a
Yeah. So I took, I saw it happen in Japan. And when I say it happened in Japan across sectors, I really do mean across sectors, right? Look, I don't like to talk about what I'm short in Japan currently just because it makes it very difficult to get access, corporate access. It's a bit of a sensitive market, but we can talk about things historically, right? So, between 2009 and say in 2012, you could draw up a list of all the large or even mid-cap companies that did equity recapitalizations in Japan. And, we're not talking about 3 or 4 sectors. We're talking about 9 or 10 sectors, right? So you had Japan Airlines went bankrupt. ANA did a massive dilutive deal. Mazda, the automotive company, did a massive dilutive deal. Hitachi did a massive dilutive deal. Toshiba did 2 massive dilutive deals. Sharp did 3 massive dilutive deals. Panasonic, I believe, did 1 massive dilutive deal. Nippon Sheet Glass, a glass company, did 2. Pioneer, the consumer electronics company, at least 1, maybe 2. These are just the ones at the top. Of course, the whole banking sector did a bunch. The consumer financial sector did a bunch. The utility sector did a bunch. So I could go on, right? Clearly, it was a market-wide phenomenon. This wasn't, and this isn't just coming out of the crisis either. Yes, a handful of them happened in 2009, but most of them were kind of structurally stressed credits that used the equity market over time, over and over again to kind of recapitalize. So I thought, okay, this is obviously a trend. And this is a derivative of what happens when you have free money for too long, right? Free money for too long, people stop thinking like creditors, right? They think entirely like equity holders, and the language of the creditor just leaves the market, right? So there was a very famous case where a company called Elpida Memory, which makes DRAM, was actually the 3rd largest DRAM manufacturer in the world at the time. I think it was 2009 or 10. I don't remember the exact year. It was around about then. They, there was a couple billion market cap, highly distressed, huge amount of short-term debt. Pretty clear they were violating their bank covenants, burning cash. DRAM was a different market at the time. It was highly, it wasn't as concentrated as it is today. There were a lot of Taiwanese low-cost players who essentially were not disciplined. There was a lot of Chinese, I guess Taiwanese guys who, were basically flooding the market because they just wanted to develop the technology. They didn't care about making money. Anyway, it was a different market, but Elpida was losing a lot of money. Japanese production costs and DRAM prices were much lower. This was before mobile DRAM really exploded. So, company was in high distress, but nevertheless, when they filed for bankruptcy, and this was one of the that actually went bankrupt, right? When they filed for bankruptcy, you had 4 or 5 buy ratings on the stock. They were not even neutral, but buys. And so when you call up the analysts, you ask them why, they said, you'd say, look, they had a huge amount of short-term debt. They lost access to the commercial paper market. Why do you have a buy? And they said, we just thought the banks are going to roll the debt. So, is an answer you actually hear in a lot of situations right now. Look, you could probably call up the German analysts. They, on this Cullen Salt's name, they probably think similarly. And there's a couple of situations we'll talk about in the US where essentially people just think you'll keep on rolling the debt forever just because, right? So look, that was an eye-opener in that I actually did file. Most of the times it didn't get to that, but even if it didn't, it was clear that this methodology was differentiated, right? Like there just weren't enough people thinking like creditors in the market, right? We can talk about in the US as well. The US is still the most sane of all the developed markets I look at, and I look at Japan, US, and Europe, Western Europe. But even so, it's still pretty lax, right? We can talk about some names if you want, but there is this underlying assumption in the market at the moment that the credit market is just always going to be open. That's a function of where HYG is, and that's a function of what the Fed's doing, right?
Yeah, certainly. I guess like a lot of times I would just ask like, can't they refinance, right? If you have like 1.5% interest rate, then certainly the refinancing at 5% is not going to kill the company, right? Or something like that, or whatever.
Yes and no. The answer is yes, of course. At 1.5% they can refinance, but what happens is potash goes down another 15%. right? If potash goes down another 15%, then all of a sudden they're not 6 times levered, they're close to 9 times levered, right?
Yeah.
And the problem is in this, I mean, look, we didn't go full on a deep dive. The problem is if potash goes down another 15-20%, it's highly likely because something has structurally changed, right? So BHP's invested $3.5 billion already over the last 6 or 7 years developing the Jansen mine. Maybe they named it after you, Jan. the Jansen mine in Saskatchewan, Canada, right? So Saskatchewan is kind of the what do you call it? It's like Newcastle for coal, right? It's the home. It's where all good potash comes from Saskatchewan. So they think it's an extremely low cost greenfield development. They spent a boatload of money just getting ready. They just approved a recent expansion and spent another few $100 million to essentially finish the feasibility study. And they're going to make a final investment decision in early 2021. Now, look, BHP has 3 or 4 massive business lines: iron ore, right? Coal, and then a smaller oil and gas business, and then a few other hodgepodge businesses, like, a bit of copper, a bit of uranium. But if they want to make a multi-decade bet on potash, and they think the long-term price is much, much higher, they might decide to spend the additional $3-4 billion to get this to production, to kind of create a beachhead in the market. Now, if that happens, then the global cost curve will go down 20% overnight. And if that happens, this company's assets are fully impaired. And the reason I say that is because, understanding the structure of the potash market, it's been a pretty disciplined market, right? So there was a cartel in potash up until 2013. Mm-hmm. So today, there's 4 or 5 players that control 70% of the market. Half the players are the Russian cartel, which is comprised of Belarus, Belarusian company, and then Russian company that's called BPC. And then most of the other half is the Canadians. That's Nutrien and Mosaic, and there's an Israeli company in there as well. But essentially, it's the Canadians. That's called Canpotex. And those 4 or 5 companies control 70% of the market. But the reason they control 70% of the market is because they collectively pursue production discipline, right? So the market's been very weak in the second half of 2019, and basically all the players responded by cutting production, right? Including KNS, which is kind of Cullinan Salts, which is kind of the odd man out, right? The high cost player who's not a member of either cartel, but has benefited nevertheless. Now, the problem is BHP is a new player, and BHP's incentives, as I described, may or may not be economic, right? They have the sunk cost fallacy, right? They've already invested so much money. So I'm not saying they decide to go ahead, but if they do decide to go ahead, then guess what happens? Then all of a sudden it's every man for himself. So all these other guys who have brownfield production that costs, a third or less, maybe a fifth of what BHP's cost of production and time to bring new production online, why should they hold back? If BHP's coming with 8 million tons in 4 years, why should you hold back your greenfield project, which is 1 million tons at $60 a ton, $70 a ton? So, immediately, Nutrien's brownfield goes ahead. Israel Chemicals brownfield goes ahead. Everyone's brownfield goes ahead. So where does that leave KNS? Well, they're still the high end of the cost curve when all the other guys who are exercising discipline gave up the discipline. Frankly, there is a scenario where the equity just jumps to zero. Now, look, that's not my base case. But when you have 6 turns of leverage, what's the scenario where BHP doesn't go ahead? Well, the scenario where BHP doesn't go ahead is where potash is already really weak.
When it's already bad for business.
Exactly.
Yeah, sure.
Exactly. So I don't actually need them to not be able to refinance the bonds to make a boatload here. I just need the banks to tap them on the shoulder and say, look, you guys need to recapitalize, right? You have, and by the way, KNS has some other assets. They have a decent salt business, which is completely unrelated to potash, which is probably a better business, which they're now trying to monetize, to sell a minority stake, right? So they're trying to kind of delever inorganically, let's say. But, it's one of these situations where heads I win, tails I don't lose, probably too much, in my view, right? So even if potash stays where it is, and even if they sell minority stakes in these other businesses at what I think are generous levels, this thing still trades well north. This thing still trades at 30 times free cash flow. Potash could blow up. Potash might not blow up. Even if potash doesn't blow up, if the market rolls over, I'm pretty damn sure this will massively underperform.
Great. That's a first nice tip. Certainly for further research, and we'll get to some of more individual stocks
Sure,
later on.
sure.
But that was a great intro to kind of how you think about short selling and how you came to kind of be focused on it. I had one more question regarding this. I on your LinkedIn you say that you worked for a relatively famous hedge fund called Lansdowne Partners. How was that experience? Did you learn something there about short selling, or what was kind of the learning experience there? You worked there for about 2 years, right, or 3
Yeah,
years?
yeah, yeah, yeah. No, it was excellent. I mean, you know, as an analyst there and on the European equity team, and it was a great
Hmm.
experience and learned a lot, both on the long and the short side. I mean, I feel like my approach to shorting was pretty formed, was well formed before I went there, Frank. And you know what I learned there in terms of sectoral and geographic coverage, because before that it was more of a Japan and US focus. So this is more of
Hmm.
my entree into European names. Learned a lot on the geographical side and the sectoral side, but in terms of methodology and approach, that was pretty much formed. To be honest with you, it was a great experience. I learned a lot, and you know, it was really helpful for my career as an investor.
Sure, sure. And so regarding sectors, do you have any focus? I mean, obviously, if I look over your picks, it seems pretty general. So maybe if you don't have a focus right
Yeah,
now, have you ever had a focus where you spend a lot of time in, and what was the kind of
sure,
outcome of that?
sure. Yeah, no, I mean, look, there's my focus is balance sheet driven analysis. So to the extent the balance sheet is a good reflection of the business value, then my approach is relevant. To the extent it's not, then it's completely irrelevant, right? So there's a lot of sectors you can just throw out that I'll never look at, right? So if you can imagine any company where the intangible value of the corporation is very, very high relative to the total value, we'll never really try and make money in those situations because it involves measuring an intangible that's very hard to measure. Think of the potash example, right? It's pretty, I don't say it's easy, but it's relatively straightforward to work out what the replacement cost is of a potash mine, right?
I
What's
mean,
the
it's hard to
replace? What's the
forecast the
what?
future price, but you can kind of understand the
Yeah,
factors.
well, I mean, look, even if you can't forecast the price, you can do scenarios, right, and figure
Yeah,
out
sure,
what
sure, sure.
work
Of
in
course.
various scenarios, right? But what's the replacement cost of Gucci? It's
Yeah.
impossible to know, right? So I'll never do luxury goods. I'll never do biotech, right? What's the replacement cost of a drug? It's
Hmm.
very difficult, right? So
Hmm.
no biotech, no pharma, probably no healthcare, no luxury, or look, I might do luxury if it's perceived to be luxury, but it's not actually luxury, right? So like a Michael Kors, right, is something I've invested in the past.
Hmm.
Um, but again, if it's pure luxury, if it's LVMH or whatever, I'll never really invest.
Okay.
So a lot of industrial sectors, a lot of commodity related sectors, whether that be, you know, commodity cyclicals, industrials, basic resources, chemicals,
Hmm.
you know, autos, OEMs, things like that.
Hmm.
Uh, Basically anything that's you know, maybe the odd, you know, discretionary name here and there, but essentially the bread and butter is commodity, is, you know, consumer cyclicals, commodity cyclicals, and
Sure.
industrials.
Sure, sure. And how do you source ideas within those sectors? I mean, balance sheet driven approach. Do you have any screens, or how do you come up with names that you look at?
Yeah, I mean, look, everyone uses screens, right? So I don't, you know, I use screens, but I'm not sure it's that. I mean, look, I try to do a few things differently to other people. Not sure we
Hmm.
need to go into it. We can if you like, but you know, I use a few modified, uh, very cash-focused metrics where I try and make modifications for things other people don't make modifications for, right? So
Hmm.
one thing I like to talk about is the structural difference in cash tax and statutory tax, right? Because some businesses, the GAAP stated tax
Hmm.
is generally much higher or lower than the cash tax, and
Hmm. Sure.
effectively what that means is you get a deferred tax liability on the balance sheet,
Hmm.
which is essentially free financing, right? If the tax law never changes and your cash tax is structurally lower than your GAAP tax rate, that's free financing, right? So
Hmm.
from a creditor's perspective, that's essentially found money, right?
Hmm.
So I will pay a premium for something like that other people might not even recognize if they're just looking at GAAP numbers. In a
Hmm.
similar way, I will tax every business I look at for working capital. Again,
Hmm.
a lot of people will look at, say, free cash flow and add back working capital. I'll never do that, right? If a business is trying to grow and it costs capital to grow, then I want to tax that business for it because as a creditor, I don't get the benefit of that growth. Well, maybe I do eventually, but I don't get the benefit in terms of cash cushion today, right? So
Hmm.
So whenever you look at it, and often these cyclical capital-intensive businesses, what happens is they build up working capital as they grow, and then when the business hits a wall, they release the working capital that provides a lot of security, right? So oftentimes a business can look really crappy on an earnings basis, but be a great bet at the bottom of the cycle because all of a sudden a huge amount of cash is flooding into the business, right? So Toyota is a perfect example of this, right? So Toyota, working capital, not a company I own, but a company I like. Huge working capital cushion, almost impossible to envisage them ever having some kind of, Armageddon event. And that's actually what happened in 2009. Business hit a wall that generated a huge amount of cash out of the business because working capital just got worked down aggressively, as opposed to some businesses that I'm short, where they have structurally negative working capital, meaning they're forced to grow to maintain that negative working capital. And if or when growth hits a wall, essentially there can be a run on the company, right? Because suppliers aren't getting paid.
The old Ponzi scheme, basically.
Going back to your question, I mean, you have screens, but the vast majority of my ideas are what I call cumulative. In other words, they're stuff I've either looked at in the past or related to stuff I've looked at in the past, right? So either the same sector, but a different geography. So look, a potash company in China or in Canada or in, Germany, it's still potash, right? A steel company in Japan or in Europe is still a steel company. If it's a global commodity business, it's pretty approachable. If they make TV screens in Japan or in China or in Taiwan, it's still a flat panel display, right? So either same sector, different geography, or an adjacent sector, right? So if I've looked at a lot of airlines, then I could look at aircraft leasing, right? If I've looked at aircraft leasing, then I could look at other equipment financing businesses. If I could look at, airlines, then I could look at, aerospace and defense, right? Or suppliers, aircraft suppliers. Similarly, if I looked at auto OEMs, I could look at the supply chain, so auto parts. So, it's pretty organic, to be honest. Like,
understood.
In my book today, I reckon maybe 85% of the names in the book are in some way related to work I've done in the past 10 years. And maybe there's a tail of 10-15% of the book that's more recent stuff that I haven't really. But again, that's, it's sized appropriately.
Sure. So it seems to me that you're more focused on the fundamentals rather than, say, the corporate governance, because obviously short sellers, certainly do like, leverage companies, but they also try to maybe sometimes find a company with bad corporate governance or some sort of event that could impact it. Is that something that you look at, or is it really just that you stick with fundamentals and you're not super interested in researching corporate governance?
Yeah, I guess you're alluding to fraud, right? So,
I mean, could be. It doesn't have to be aggressive accounting, whatever. Creative
accounting that gets to fraud. So, look, here's the problem with fraud. So, by the way, I'm not against fraud. I'd love it if all my companies that I'm short are frauds, right? And they blow up. But I don't use it as the basis for my investment. And here's why. The problem with the fraud is, unless the balance sheet is busted, it can go on for a very, very long time, right? So, of course, you see in the headlines the examples where Muddy Waters writes it up and the stock opens down 50%. Those are the winners, right? Credit to Carson Block or whoever that can generate that kind of reaction. But those are the good outcomes. What you don't see are the ones where it was a fraud, everyone knew it was a fraud, and you still got massively screwed because they didn't have any leverage and they shut the stock for 5 years. So there's a famous company in Hong Kong called Hanergy. Hanergy.
Is it the one that the shares were like stuck forever, or?
Yes. At one point, this was the largest market cap on Hong Kong, or close enough. It was insane. It was like 100 billion or something market cap. The stock just went parabolic, and then they stopped the stock. So yeah, it went parabolic and it came back a bit, and it was clearly it was a very tight float. So it was a bit like the Volkswagen Porsche situation, right? But that aside, the stock went parabolic. It was in the market that it was a fraud, right? I mean, the guy disappeared, basically. The guy who founded it disappeared.
Yes.
They were gaming the closing price. They were doing a commodity, making solar modules or whatever, a product. There's no way they could have made those profits, but they closed the stock for 3 years. So what happens if you're short? You can't cover, and you're paying crazy borrow, and they close the stock for 3 years. Or, I mean, that's a bad outcome, but what happens when it's a fraud, but then they turn it into a real business? So then there was another company in Korea called Celltrion. I'm not sure if you heard of this.
No, I haven't heard of that one.
I think they're still around. It was a biotech company where I don't know the details, but one of my, a couple of my ex-colleagues were shorted. They were short as a fraud. They were basically lying about the data. And, all this stuff came out. The stock went down a bit or whatever. But they didn't have any debt. They survived. And guess what? Their other business worked out. Their biosimilars business took off. And the stock went to the moon, even though it was a fraud. So...
Yeah, sure. I mean, it is tricky. It is tricky to say the least.
There's one company in Japan right now that, well, let's not talk about detail, but it's a large cap. I don't know. I'm quite confident there's something fraudulent going on. You can never say you're 100% confident, but you can't make head or tail of the P&L just relative to the comps. And there's a huge amount of scuttlebutt, and it checks all the boxes basically for a potential, not just aggressive accounting, but potential fraud.
What's the business, or what's?
I don't really want to talk about it in too much detail.
Fair enough.
It's been around for decades and it has no debt. So even if it's a fraud, they don't have debt, right? They just they will just have much less cash than they say they have. So, I mean, look, let's talk about one in the past. Then Olympus, right? Olympus, the endoscope maker, 7733, was a massive fraud, one of the biggest in the world. They were basically what they did is they overpaid for a bunch of acquisitions that had no value, and they did that because they were basically paying off the Yakuza, the organized crime, is what it seems like. They were paying off money under the table to probably organized crime, and they were hiding it by taking, hugely inflated acquisitions where they just, pay $1 billion or $500 million for something worth $10 million, right? So, of course, there's a huge amount of goodwill on the balance sheet. The cash returns looked terrible, and eventually they had to write it all down, and they got rescue financing from Sony and a bunch of others. Lost in the story was this was going on for almost a decade, right? These transactions happened between 2000 and 2005. The fraud was only uncovered in 2010. And guess what happened between 2005 and 2010, right? The stock went up. So, and why did the stock go up in a straight line? Because they had no debt. They had no debt and they had a real business as well, right? So, not to say I hate fraud, but fraud alone is a tricky proposition, right? Without debt. So debt is like the gravity that, too much debt is like the gravity that in an ideal world brings some of these, either crappy business or potentially fraudulent or aggressive businesses back to earth. And even in today's day and age, that is something that I hang on to, that, without that gravity, without that leverage burden on the company, forcing them to come back to the market over and over again, it's just very difficult to stay in some of these fraudulent trades.
I mean, you always need a catalyst. I think that's the basic, basic thing. But really great stories, and I think great points as well. Now, who are your favorite short sellers? Who do you like to follow?
I mean, to be honest with you, the vast majority of the published short sellers, they don't really follow my approach, right? So it's not. I don't have anything against them, and if it works for them, that's great. But a lot of them do great work, and it's based on, as we discussed, it's on the fraudulent angle, right? It's on the creative accounting side. So, those guys. I mean, Bonitas Research has done a few good pieces. I think they overstepped the mark recently, but Aurelius as well has had some good pieces. To be honest with you, I try not what other people are doing. By the time they're publishing, I think this is very true of people like Citron and Muddy Waters. Look, you don't know if they're in fact covering their short day of, right? If you read the disclaimers for some of these guys, the business model is essentially, and by the way, I short stocks, so I'm not anti-shorting, but the business model is a little bit strange, right?
Sure. I mean, in some examples,
they publish a hit piece, but they say in the disclosure, we may trade this at any time. And if the stock marks down 50%, who knows if they even have 1/10 of their position once the stock's been created, and then they're still banging on at the company, but they've made their money, and who knows, they may have moved on. So, look, that's their prerogative. I try to do my own work basically.
Okay, sure. No, and it doesn't have to necessarily be focused on fraud or something. Just someone that inspired you. It doesn't have to be within this space.
What I would say is there's a network of guys on sites like Value Investors Club, which I'm a member of, and a few other places who do excellent work, much more business and balance sheet driven than pure creative accounting. Although that kind of good work is on there as well, and And that I like that because a lot of that is it's either anonymous and there's also a forum to discuss back and forth, right?
Mhm.
So you can
Sure.
push these guys on their thesis. Like if I can't call up Andrew Left and
Mhm.
ask him why he thinks Peloton is a short now. Not that I would want to, but I think the work is, I don't know, it's definitely different to how I approach things. It's much more trading oriented, I feel, and
Mhm.
I don't think it's very fundamental at all. But anyway, I can't, it's difficult for me to say call up Carson Block and kind of break it down with him. Whereas, in some of these other forums, you can really go back and forth with people and learn a lot. So there's more some guys, probably anonymous actually, who I look up to on some of these sites.
Sure, sure. No, I get that. And I think a lot of times, you don't really get to hear about a lot of the shorts that worked out just because they were fundamental. They were not necessarily flashy stories. So I think there's certainly a lot of going on there as well, maybe under the radar, so to speak.
Yeah, yeah. I mean, I definitely think it's true. By the time you see these high-profile short hit pieces come out, either the money is made that day or close enough to that day when it comes out, right? By the time you're picking over it, unless it's a pure bankruptcy, this is a zero type short, which the vast majority of these are not, right? So you take a look at the Peloton piece, right, by Citron. I'm not trying to pick on Citron just because it came out quite recently, right? Essentially, he's making a TAM argument, right? The TAM is massively overstated. Okay, that may be so, but it only takes a few more idiots to think the TAM is not overstated for you to get blown out of that trade, right? The balance sheet's not impaired. He made the Fitbit analogy and the GoPro analogy. What he left out was the fact that Fitbit and GoPro both went up 2-3x before they blew up. So I actually think that's an extremely dangerous short, personally. It may well be right in 3 years, but I don't know why you'd want to take a shot at it now.
Well, you yourself shorted Netflix, right? And Tesla. So we'll get to that because I believe that Peloton and Netflix and Tesla, it kind of similar style of shorts or like.
So we can talk about those if you want. So actually, Netflix, I never shorted. I'm very
Oh, okay.
skeptical of the. I never shorted it. I did say I thought it was massively overvalued. It will never earn anything close to the returns required to justify the price. Let alone, I actually don't think it will ever make sustainable free cash flow as I measure it. And it's very simple logic as to why, right? So if you just drop spending to zero now, I guess taking it back a step for people who aren't familiar, Netflix doesn't even disclose their monthly churn, right?
Mm.
So in a business like that, where it's all about the value of the customer, the most important data point you could possibly receive is what your monthly churn is. They don't disclose it. There's only one reason they don't disclose it, because it's higher than they'd like. Whatever. Let's just assume monthly churn is 6 to 7%, 5 to 7%, which is in line with basic cable or whatever. So it could be a bit higher, it could be a bit lower. It's probably a bit higher, otherwise they disclose it. In any case, what do you think churn would jump to if they just stopped spending money on content today? If they ran the business for cash today, right? What do you think churn would jump to? 10%? 15%?
Probably more than that. Yeah, sure.
Yeah, exactly, right? So if you do that math, right? If you drop CapEx, go forward CapEx to essentially zero and work out what free cash flow is, levered free cash flow, because they have a bunch of debt. Then you work out, okay, what multiple of free cash flow is it trading on? It's still trading on 30 times free cash flow or whatever, right? Well, that's a problem if real churn jumps to 15%, that means you have 7 or 8 years maybe of cash coming your way, but it trades at 30 times free cash flow. So by definition, you can never get paid back. So what do? You have to keep spending money so people don't look at underlying free cash flow. Why? Because they're looking at subscriber growth. So, I mean, by the way, I'm not short Netflix, but just as a business proposition, I really don't understand it. I mean, on the most recent call, Reed Hastings was talking about the business, and someone asked Ted Sarandos, what do you think content cost escalation has been over the last year for premium content? And he said, at least 50% or something. And on the call, the CEO said, no, it can't be that high. And Ted Sarandos said, yeah, for premium content, it's 50, 60% higher year over year. I was like, people think this is a SaaS business. Costs are going up 60% a year. SaaS businesses costs stay flat. So, I mean, it's just insane. But anyway, I'm not short it because it's levered. I put it in this basket of stocks where, I don't know, it's like the 4 horsemen of the apocalypse, right? They're like the 4 horsemen of the bull market. It's just until something changed in the high yield market, it's very difficult to short a stock like that. Yeah, we can talk about Tesla if you want. That was my biggest loser last year, and
I think regarding Tesla, I mean, because in the end, Netflix and I think Peloton was similar thesis. Obviously, didn't short Netflix, but I think the kind of way was very similar. And maybe for Tesla, the only thing I would ask is, what is the one thing that you're taking away from shorting Tesla?
Well, look, so let's put it in the framework of my methodology, right? So, look, I'm not going to pretend that I know more about Tesla than many other people, and it's obviously way heavily too shorted, and that's part of the problem. But the thing I think I have a good sense on more than most market participants is how levered they are and how many games they're playing with their balance sheet to maintain the leverage at still a very, very high level, but a sustainable level, right? So the vast majority of people who look at Tesla, they don't understand that Tesla's capex is strategically understated by the fact that a huge amount of capex runs through financing cash flow, not investing cash flow, right? Effectively, what they do is they were getting Panasonic to spend the money to build out the Gigafactory for them, or the equipment within the Gigafactory. And then they basically lease it from Panasonic, and therefore it shows up in financing cash flow as opposed to actual capex in investing cash flow. They use the exact same approach to keep the Shanghai Gigafactory off the books, essentially by constructing a finance lease with the Chinese. That doesn't explain exactly how all the funding for that's still off balance sheet, but that's another topic. But in any case, I had a very concrete view heading into the end of early 2019, end of 2018, early 2019, that they needed to raise money, right? That they were going to trip their covenants, or at least not trip their covenants, I should say. They would be very low on sustainable cash after the bond matured in, when was it? February, March, something like that. There was a big bond maturity. So I had a very much a credit-centric view of the situation. And at that time, if you recall, it was very unclear if they could even access the capital markets, right? So Elon was being sued by the SEC. They had not settled with him. They were taking him back to court. They did an acquisition of a small company called Maxwell, which was only a $200 million acquisition, and they did it in stock. So then they filed the statement to register the stock to be issued. The SEC would not approve that statement for a very long period of time, 5 weeks. So there were these, 4 or 5 data points suggesting it would be very difficult for them to raise equity. At the same time, it was clear that their $2 billion cash balance at year end was basically overstated, right? So you could back into what cash was during the quarter, but whether that be by looking at interest income, or whether that be looking at changes in fixed assets, or there are a few other ways to do it. But essentially, or how much cash was onshore versus offshore. But if you worked out that at least $500-600 million of cash was in China for the Gigafactory security package, that the interest income was a more accurate reflection of how much cash they had, then they were pretty close to under $1 billion in cash by the end of the quarter. And this is not a business you can run on less than, really $1 billion of cash is kind of baseline liquidity, right? Around 4% of sales, whatever. So it was touch and go whether they could raise equity. If they couldn't raise equity, maybe they would have to do something else that could be very damaging to the stock. So the original thesis, over and above that this is a crappy business with leverage, was I actually think there's trigger risk here. And it's something that I think Einhorn spoke about in his letter subsequent to that. The real issue, or the real problem that I suffered from, or mistake I made, let's say, was I should have covered once they sold stock. As soon as they proved that they could just tap the equity market and they raised $2 billion or whatever, I should have just covered and moved on. Because the key for me was the credit thesis, right? That it would be very difficult for them to tap equity. They might have to do some kind of pipe deal or some deeply discounted equity deal in the hole. They might have to secure a lot more assets. Once they proved that Goldman Sachs didn't care, they were being sued by the SEC and would just underwrite any deal, that was it. I should have just covered. And if that was the case, I would have covered at 250 or whatever, 240, 250, instead of covering it after earnings at 300 or whatever. And paying, I owned a lot of puts as well, right? So essentially paying all those puts down. So look, the lesson was once the credit catalyst disappears, you got to move on. You have to move on because we're just not in that kind of market where anything else matters, right? Unless it actually looks like the company is going to hit the wall, it's just extremely difficult to short anything.
Sure, I get that. No, that was, I think, great learning lesson, and I think it was great context as well. So that helped a lot because yeah, certainly I don't talk about Tesla that much because I think yeah, it's been talked over so much, and I just don't really have a view on it anymore. I mean, Elon doing whatever, I just don't have a view on it because I think it's so
Well,
much.
it goes back to our discussion on fraud, right? So if you were to construct all these guys who put out these notes, not on Tesla, on these other companies, right? And they say, oh, look, it has XYZ red flags, and the CEO left, and his uncle has a related party transaction, and they're doing creative accounting. Every single one of those is 1/10, 1/20th of the egregiousness of Tesla. Tesla literally flags every single red flag you have ever imagined for a potentially fraudulent enterprise, right? Whether it be executive turnover, whether it be self-dealing, whether it be creative accounting, whether it be changing the depreciation schedule on their tooling, whether it be stock-based compensation, whether it be the way they account for, as I said, their leases, whether it be the way they account for their off-balance sheet debt, whether it be the way they account for their warranties, whether it be the way they account for their lawsuits. But the point is, it doesn't matter because they have market access. So the lesson for me was, look, I'm sure I will short Tesla again. That may be when the stock is $50, maybe when the stock is $20, but I realize it's a much better short. It's kind of like the Enron analogy, right? It's a much better short when it's trading down 80% than when it's down, than even at 450, because it might go to 1,000 before it goes back to $10 or whatever, right? So that was the lesson for me. I'm not going to take a shot at it until it's down 80% from here, or I don't know, until they clearly lose credit market access.
I would like to also ask about the Chinese clone of Tesla in a bit, but before we do that, you probably know what I mean by that. I would just ask, what was your best and worst trade, and what have you learned from them? Well, and if Tesla was the worst, and like the second worst or whatever.
Let's put Tesla as the worst, okay? Because honestly, in terms of P&L, that was definitely the worst.
Okay, so if second worst or something like that.
Every year the mistakes get more costly, if you know what I mean. Well, which is what you want, right? If that means you're hopefully growing assets. So every year the mistakes get more expensive, but that was clearly, we'll put that down as the worst. Look, in terms of the best, I don't want to talk too much about past triumphs, but I mean, look, going back to say when I started writing publicly in 2013, 2014, using this approach, there are a lot of wins. There are a lot of wins going back then. So I've made a lot of money shorting, surf apparel as a category. Mm-hmm. So basically, I shorted Quicksilver from $1 billion market cap to zero, went bust. Shorted Billabong as well. Didn't go bust, but almost. Shorted a bunch of, fast retail, not fast retailing the company, but, what's the word for it? Fast fashion type names, or teen retail names. Aeropostale, Cache, here and there over the years. Elizabeth Arden was probably my first published article, I think, on Seeking Alpha. Again, it was a credit-based short, far too levered, failed bid from a Korean company, need to recapitalize. The Quicksilver one is probably my favorite just because it really exposed the methodology, right? So, I mean, look, this is ancient history, but essentially the reason they went bankrupt was it was underlying a crappy business. They were trying to sell $50 board shorts when everyone else was selling them for $20, right? They had structurally high. Well, they had to pay all their athletes to maintain the brand because they only sell 20% of the clothes to surfers, but they need to see that the other surfers are wearing them, right? So structurally high cost model, even though the price point for the product was just completely commoditized, and a huge amount of debt. And the structure of the debt was the real key because they had tapped out their subordinated debt, and the only debt facility left to them was a senior secured facility, right? So imagine a company that has, forget the numbers, but 700-800 million of sub debt and a senior secured facility with up to 200 million of capacity, and they start tapping that. So by the time they fully tap that 200 million of capacity, they need to get an extension or roll it over or whatever. Why would the 200 million of senior debt just roll over when they have 800 million of debt below them that's going to get coverage if they put in new capital, right? There's no way they would put in new capital, which is essentially what they said. They just, said we're not going to put in new capital, which essentially forced the company to restructure. So it was kind of a great example of my approach and what I look for. So that's why I say it was a big success. In monetary terms, it was obviously not significant. But I guess in terms of big hits recently, the biggest one has been cannabis. So I've been massively bearish cannabis over the last 6 to 7 months, let's say, from maybe a little earlier, but got really bearish basically last summer. And again, it's kind of the similar kind of story. You have fundamentally a terrible business, just a commodity product in massive oversupply. The reason there's massive oversupply is because you had a boom, and during the boom, capital was too available, and every Tom, Dick, and Harry wanted to build a greenhouse. But the demand just didn't follow through. Part of the reason the demand didn't follow through was regulatory, right? So the pace of regulation was much slower than people expected, but part of it was the cost. So I don't know how much you know about cannabis, but in Canada, obviously the cost of growing cannabis is pretty high relative to other parts of the world, right? You have to grow a greenhouse because it's cold. But, in Mexico or Colombia, you can grow cannabis for 20 to 50 cents or whatever a gram, right? In Canada, the wholesale price today is maybe $4 a gram. So you have people growing weed in Colombia or Mexico and exporting it illegally and selling it in the black market in Canada at $4 a gram, whereas the legal guy is selling it at $10 a gram until recently, or $8 to $10 a gram. So what do you think? What do you think the consumer is going to do? They're going to go to the guy in the corner, right? Because weed is weed is weed. It's not a branded product. So so that was kind of the underlying. Do the work on the market, understand how imbalanced supply demand is. You go to Health Canada. They have the data every other month. They put it up, but you have crazy inventory numbers, right? So
I saw those. It's insane. Yeah,
it's insane, right? So they had 2-3 years worth of inventory being built, and then all these guys keep saying we're bringing more inventory online, and so the only way for these guys to cut costs is to get more economies of scale, which is to which means which means they have to keep producing. It's exactly the same as a high fixed cost kind of manufacturing business. So then I just picked the 4 or 5 of them that had a lot of leverage or a decent amount of leverage and just shorted them, right? So names.
So again, it was the credit aspect that made you choose the players.
Yeah, because that's the gravity, right? So the guys who had leverage are being forced to do something about it, right? They're being forced to either cut production and therefore their costs go up, or they're forced to, because the creditors make them true up their inventory balances more aggressively than the non-levered ones, right? And they also have to have more trouble raising cash if they're burning cash, which they all are, right? So look, I didn't have a massive short in Aurora, but I had a very big short in Hexo. I had a decent short in Tilray. Tilray is probably still a zero. Hexo is probably a zero. Had a decent short in CanTrust. Got lucky there. That turned out to be a fraud, basically. But that's another story. And I also had a short in Canopy Growth, which is not levered, but there's more of a sector bet and for liquidity. But essentially, these names have been in permanent retreat for most of the last 7-8 months because, as I said, it's kind of a structural issue with the industry. You just need to see supply leave the industry, and the guys who are levered have no options. They're forced to dilute over and over and over again, which is essentially what's happened with Hexo, my biggest short in the space. Although, full disclosure, I've cut it back a bit recently, given how much it's fallen.
Sure. Now, before we go on to timing, because I have a really an important question regarding timing, because especially when we talk about, for example, cannabis, this is obviously, the focus or the trend has turned, right? And a lot of the stocks fell down even without the credit aspect. But before we do that, I just have a question about retailers. Do you have any idea? Because of course this is relatively leveraged, or some of them are relatively leveraged. Have you looked at some in the US?
You mean like Bed Bath & Beyond and these kind of things?
These kind of things, yes, exactly. Yeah. Like brick and mortar malls, whatever.
Not so much recently in the US, just because, look, a lot of the worst ones already filed, right? So in 2014, 2015, a lot of the teen retailers disappeared. A lot of the smaller, crappier ones disappeared. I was short a lot of those, to be frank. The ones that are hung around this far either have a bit better businesses or not as much funded debt. So obviously they all have leases, whatever, but not as much funded debt. And often it's the funded debt that kills you. So I haven't really done much either way in retail in the US. In the last couple of years. I've done a fair bit in retail in other places, other geographies. So I'm betting against. I was betting against a German shopping mall REIT called Deutsche Shop, I think is the name, which is a good trade. I'm betting against the Hong Kong REIT at the moment. It's a bit of a derivative play on Hong Kong real estate, and also I'm short a few Japanese retail names. But In the US, not so much.
Okay, sure. And so now on to timing, because that's really the question of short selling, right? You can have like different strategies, different focuses, but at the end of the day, it's all about timing. So
Sure.
how do you think about that? Do you have some sort of process? You know, can you give us an example of good timing, bad timing? How do you just think about this?
Okay, so if I was Spruce Point, right, timing would be extremely important because the vast majority of their positions are, this thing trades at 25 times EBITDA. This is a crappy business. It should trade at 12 times EBITDA, right? Or some variant of that. They're making a valuation argument. They're making a business quality argument. Most of the time, those guys are not making this is a zero argument. If your thesis is this is a zero, the timing actually becomes much less of an issue. And in fact, the most important thing then becomes sizing, right? So look, let's take Hexo, for example. I shorted it. The stock was already down 50% off its highs. It could have easily gone up 20% in my face, 30% in my face, which would have been painful, but presuming the sizing is okay, then I can wear it. The reason I'm much more nonchalant to say about the timing is because I think it's worth nothing. If it's worth nothing, then, and I'm really confident that gives me the ability to get the timing wrong. And most of the time, you'll get the timing. Maybe you'll get it right sometimes, but the vast majority of the time, you won't time it perfectly, right? Just like buying a stock. You never buy the bottom. You probably never sell the top. So that's why I really like to focus on zeros or almost zeros, right? Because that affords me the ability to not get the timing perfect because I've never been able to get the timing right. Who knows what's going to happen tomorrow or next week? Of course, I will try to position accurately ahead of key catalysts. But again, what I think is a catalyst, maybe not everyone else thinks is a catalyst, right? That's been proven to be a few times recently as well. So I would love to be better at timing, but actually nowadays I try to think a lot more about sizing and think, okay, I'll put X% on now, 1% on now, maybe 2% on now. I have some skin in the game. If I get the timing wrong, that's okay because of, it's sized appropriately. This could happen against me. This could happen, but I have more bullets to fire. And that's how I think about it.
Fair enough. So essentially kind of look at the thesis and let's say look at the catalyst, and then essentially you just say, okay, I'm going to start with a smaller position and size it.
Exactly. Think of it this way, right? I could have, let's use NIO, because we should probably talk about that. NIO's third quarter earnings report was on December the 30th. If I looked at that, and by the way, they only announced that a week before and it was very late and the numbers were terrible, but I would have thought that would be a negative catalyst for the stock. In advance of the time, I would have thought this would be a negative catalyst. And using that, I got to time this correct approach. I would have, added to the position, say, 2 weeks beforehand. Well, guess what happened? The stock market went up every single day in December, and every heavily shorted stock went up more. So even if I had tried and probably positioned for the catalyst accurately, I still would have got carried out. So again, not to say timing is completely and utterly irrelevant or hard to measure, but or impossible to measure, but it's just very difficult. Maybe you'll get it right some of the time, but I really try to focus on the medium-term end game, right? If I have a very concrete view of what it's worth in 18 months, 12 months, then okay, maybe I'll be wrong where I buy it now or sell it now, and I get another shot at it in a month or two, right? Yeah. Now, if the analysis is wrong, it's wrong, but the timing aspect, I feel, is one of the more tricky parts of the equation.
Got it. Well, now let's turn to NIO, because obviously you started a bit as well with the information that happened or the events that happened at the end of the year, which were really surprising. So NIO is some sort of a Chinese clone, let's say, of Tesla, less the chief Twitterati, I guess. The probably one fact for all is their cash burn, which I really am amazed with. In the last quarter, the car company burned through over roughly $300 million, which is this calculations by Financial Times. So
yeah,
I guess
they burned $600 million the quarter before, so that's progress, right?
Yeah, sure. I think Uber is tipping its hat somewhere though for the numbers. They were burning similar.
Uber has a 50 billion market cap, right? Anyway, if the real way to look at it is how much cash are they burning relative to their sales. So
Yeah, I
they're
mean they
burning,
have
they're
negative gross
burning,
margins.
they're generating 100% negative operating margins, right? I mean, that is pretty incredible. Look, I don't know how deep you want to go on Neo. Like, I don't know how much time you have,
I
but
think with Neo I would be really interested because obviously it went up. Everybody knows about the bad results. It doesn't make sense. I mean, they have negative gross margin. Operating margin, fair enough. You can't argue it away, but let's say you could. But gross margin, I mean, if you're selling a car at a loss and you have negative gross margin, that's it, right? So maybe it's just like, what do you think about the future? What are the catalysts? What are you looking at? And
okay,
how do you think about the
sure.
position?
Okay, look, so let's take it back to first principles. Why did I short this in the first place? So first, full disclosure, I shorted this first at like 550 in, I don't know, March, April of 2019. I've lost money on it, even though the stock price is lower, because I added significantly to the short at lower prices. But what attracted me to the short is what still attracts me today. Look, this company, there is just no equity value there, right? There's no equity value for a few reasons. The first and most important is this is structurally a terrible business in a terrible market, right? So you think EV is bad in Europe or getting more competitive in Europe and the US? Well, EV in China is the worst business you can imagine. I think there's over 200 different EV companies in China. Within NIO's market segment alone, there are about 40. And this is not a large market, right? So China, maybe 20, 25 million cars a year get sold in China. But the number of pure EV cars that get sold to consumers as opposed to fleets or governments, it's really only 300,000 cars a year. Okay, so 40 premium names competing to sell a few 100,000 cars a year. And by the way, Tesla's building a factory that can do 150,000 cars a year. So what's that going to do? But anyway, that's kind of the background. But even within the scope of a terribly competitive market, NIO itself is almost set up to fail. The reason I say that is because they don't own their own factory, right? So if they owned their own factory and they were successful in building a brand, then they could enjoy the operating leverage of the factory. They could sell 10,000 units one year and then 100,000 the next year and see a huge ramp in profitability. The problem is, because they didn't own their own factory, they didn't have money to build a factory, they outsourced production. But in order to secure the production, because it's a competitive market, they had to guarantee the losses of the factory that makes their cars for the first 3 years. Moreover, they also pay a fixed fee per car to their partner, their manufacturing partner, which obviously crimps your profitability. So on the one hand, they have a fixed kind of remuneration that's kind of fixed no matter what happens with their volumes. On the other hand, they also have to take on a lot of the capital requirements of a typical automaker, right? So they design the cars, they buy their own tooling, they supervise manufacturing, they just don't actually manufacture it themselves. So they have and obviously they have all the R&D and all the sales force of a typical auto OEM. In fact, probably more given their scale. So they have, a lot of the unattractive qualities of a typical OEM, and they have few of the attractive qualities, right? Less operational leverage. And, you see this in the numbers, right? So if you go back a few, even when quarterly sales went from, couple thousand to 3,000 in Q3 2018 to 7,500 Q4 2018. So they doubled production, but incremental margins were only 15%. That's a huge problem, right? If your incremental margins on doubling production are only 10 to 15%, that number should be more like, 40, 50%, right? There's a few other problems. One of the other major problems is they never had a brand, right? So in order to build a brand, they did a few things. One was they spent a huge amount of money on big ticket, kind of conspicuous neo houses, which are kind of like a cross between a health club, a members club, a daycare center, and a car dealer. But they're kind of like the WeWork of autos in China, right? You go there and you have a great experience. You watch a movie, go swimming, leave your kids, and maybe you buy a Neo sweatshirt or something, or maybe you get put on the mailing list for Neo. That costs a lot of money. Then they also spend a huge amount of money on, building a brand, but they also spend a lot of money outside of China, right? Trying to credentialize their product. So they opened 4 different R&D offices around the world. They hired, not insignificant employees. They hired a few hundred people to work in Silicon Valley. They hired 70 people to work in Munich designing cars. They have 2 R&D offices in the UK, for example. So they spend a lot of money. And then the final part of the offering and why gross margins are negative is they're giving away a lot of stuff for free. So NIO basically has this thing where they give you free lifetime battery swap. And as you know, the battery is the largest single cost component of an electric vehicle is the battery, right? It's depending. It used to be half the value of the car. Today, it's maybe 30 to 40% of the value of the car. Over time, it's going down, but let's call it a third of the value of the car. Well, if you give the ability to swap the battery out for free, it forces you to do two things. One, you have to keep an inventory of batteries around, which, by the way, that's not cheap, because the battery is very valuable. But also, there's no incentive for your users to take care of their battery. So let's drive these cars dead, then go into a battery swap and get a new battery and roll along. So that's a huge cost that you have to amortize through the P&L over time, right? Recently they've done a few other things where they've started to give free lifetime warranties, free servicing, all these other discounts, big ticket discounts off this ASP to generate sales. But essentially that's the crux of it, right? No limited operational leverage and structural inability to earn a decent gross margin on the car. So what's happened recently, look, I cannot explain the stock price. It doesn't make any sense. But in terms of what's happening with the business, essentially what happened is over the summer, they almost hit the wall. They almost hit the wall because they had a battery fire issue and they had to do a recall, and a quarter of the cars they'd sold had to be recalled and had to be repaired. And that caused reputational damage, and obviously it also cost them about 50 to $60 million, a decent amount of money for this company. Now, look, obviously this company is burning a boatload of cash, and so they reported at the end of September. As I said, they burned close to 600 million in the quarter, and they only reported 500 million of cash on hand. Now, they've already come to the market twice. Once for the IPO, where they raised, I think it was over $1 billion. I need to double check. And then they also sold 750 million in converts 3 months after the IPO. I mean, that's how fast they were burning cash. So this is a company with a lot of leverage, right? At this point, they've got over $1 billion of net debt for a company doing negative EBITDA, negative gross margins, and conservatively burning $1 billion cash a year, even if they get their burn under control. So they came back to the market in September and said, look, we had a terrible quarter in June. We lost, we burnt 600 million, but we're going to cut costs. We're going to try and improve operations. We're going to improve deliveries. And we're gonna raise more money, right? They've been trying to raise money for 6 months. They haven't raised any. So obviously, with only 500 million cash on balance sheet, it seemed pretty touch and go. And then they come back to the market with the 3Q numbers, not the 4Q numbers, the 3Q numbers. And all of a sudden, there's only really three things people care about in my perspective, and that's what's the cash balance, what's the cash burn, and have you raised any new money? Well, okay, cash burn improved. We only burnt $320 million. Okay, what's the cash position? Well, 275 million. Okay, so why is it a bit better? Well, they managed to raise 100 million from Tencent via a convertible bond. So, that was a small positive. And they also got another 90 million coming in from Bin Lee, the CEO, who is going to give them a little bit of money. That didn't close during the quarter; it closed during 4Q. But the real reason they've been able to survive is because essentially they are not paying their suppliers. So suppliers' days, so payables days, which is a balance sheet item, jumped to 120 days Q over Q. Went from, jumped 50, 60 days Q over Q, and I think payable days is around 150 days. So basically they, payables alone went from 2 billion to 3 billion renminbi, so 150 million in swing just from not paying your suppliers. So I think I mentioned earlier in the podcast that the problem with negative working capital is, if you don't keep growing, then that really rebounds on you because you have to pay your suppliers eventually. And the problem is you can't keep growing if you flush your inventory and you don't have capital, right? Because you have to rebuild your inventories and then you have to pay for growth, essentially. So that's where we are today. So inventory as of Q3 was actually, 1.8 billion. So call that 220 million USD. 250 million USD, let's say. So that's probably been blown through now in terms of they just cut prices to move units, right? That's why the unit numbers exploded. So the unit numbers exploded, kind of like Tesla in a way. Everyone thought that's great. There must be a huge amount of demand. But again, if you're selling something at minus 20% gross margin, then it's basically you're just running around the inside of the bottom of a well, right? So that's kind of where we are today. I mean, look, they have 270 million as of the end of Q3. Right now, cash balance is probably 150 million, maybe 200 million. Now, within the next 12 months, they have 1 to 1.5 billion of operating cash burn they need to fund. They have the negative working capital balance that needs to be fixed. That's probably 200 to 300 million. They have to pay the Chinese banks. They still owe money to the Chinese banks. They've been net withdrawing money each quarter, the last 2 quarters. They're still owed $380 million. In other words, if they do raise money in the public equity markets, the first and best use of that capital is straight out the door to the Chinese bankers. So you add that all together, and to survive 2020, I mean, look, the number is 1.5 billion, right? It's not small potatoes. So that's where we are. I mean, the fact the stock ripped is probably more a comment on the broader market and the quality of the investor base in this particular company. And look, it's very painful for me, obviously, but there's no way out for this company, right? If Tesla does even a third of what they say they're going to do, there's just no way prices don't go down a lot more in 2020. If prices go down more, as I said, a lot of their costs are fixed. A lot of their costs are fixed even as volume ramps. So, I mean, look, if the stock stays high enough, maybe they can sell enough shares. But the only reason the stock is high is because there's a massive imbalance between supply and market, right? So if they sell 500 million, 400 million in stock, all of a sudden that's 400, 500 million more stock that can be shorted. So unless that stock goes to, Bailey Gifford or Tencent, then that's in the borrow pool. If it's in the borrow pool, there's no way the stock stays at 3.5 billion market cap.
Sure. I mean, is there anything specific that you're looking out for? Any specific event that you feel might change the?
So look, I think they have 150 to 200 million of cash on the balance sheet as of the end of the year, and they're burning 100 million a month, right? So by the end of January, they'll have. Look, it's not a stretch to say they'll have under $100 million. There are almost rumors. There are rumors in the market, in the Chinese press, what have you, suggestive that they cannot make payroll, that they had to delay payroll. Think about that for a second. They had to delay payroll. They put a going concern note in their accounts, and the stock still almost doubled. It's pretty crazy. Anyway, so by the end of January, they might only have $50 to $100 million in cash, but they have a bond coupon on the foreign converts of $17 million. Now, if they haven't raised money by that point, you have to really question why Chinese banks or Tencent would let them pay that bond coupon, given it would be a huge chunk of their remaining liquidity. Look, it's not a huge amount of money. Personally, I think they can make the payment. They'll just stiff suppliers again. But if they keep stiffing suppliers, then January and February deliveries are going to look terrible. If January deliveries look terrible, if they don't continue the growth trend, the story dies. So they're much better off to sell a boatload of equity in the next 2 weeks, so that at least they can pay suppliers, pay the banks, and at least keep printing decent sales numbers, delivery numbers, because that gives them the ability to survive another quarter or 2 quarters. At the end of the day, I still think it probably hits the wall, whenever Tesla deliveries take off in China, right? Because pricing is just going to get obliterated. Right now, the Model 3 in China is 20% cheaper than NIO's cars. Now, who in their right mind is going to buy a NIO car over a Tesla car if it's made in China with the Chinese incentives? I just think it's going to obliterate the market. I mean, look, by the way, we've seen this before,
Sure.
right? We've seen this in display panels. We've seen this in televisions. We've seen this in solar modules. China is a terrible market when there's an oversupply situation, which is where we are in EVs. So, look, maybe they don't actually hit the wall fully in 2020. I actually thought they would by the Fed bond payment. I underestimated how much suppliers would be willing to work for free. But again, this is just unsustainable. You can't burn 200-300, even best case, $250 million a quarter. You can't burn $250 million a quarter and expect to be funded, even in this market. It's just insane. So, look, whether it ends now, whether it ends later, it will end badly. I have maintained my short, which was outsized, even despite the rally, because there's not a better risk reward on the short side in the market at the moment.
Let's see how 2020 is going to shape up in NIO. It's going to be certainly very interesting to follow. Do you research anything currently that you're looking into and you're saying, wow, that's interesting on the short side?
I mean, most of the stuff that's in my book, I've already done the work and I'm pretty comfortable with it. Yeah, I mean, there's a few things I'm looking at right now, but nothing I'm really ready to talk about.
Okay.
Either I haven't done the work or I haven't built the position. So basically, stuff
Sure.
that's in the pub that I'm published on my blog, I'm happy to discuss. The other
Sure.
stuff, if I'm still working on it, then I need to do a bit more work and or finish the position.
Fair enough, no problem. And then, well, one other name that I meant that I noticed in your blog, which was quite interesting, was West Shore, which was this coal terminal, and that was really interesting because it had a catalyst of a customer essentially not prolonging the contract. So coal terminal is just a place that ships out coal, right? And West Shore has a huge customer concentration. So it is still, it was a bit down, but not as much as you would like. You wrote about it in early 2019. So do you still think the thesis holds there, or do you think still that the customer will not prolong and will?
West Shore is not my typical short just because it doesn't have leverage, right? And in fact, it actually was a very good business, and maybe today it still is a good business. So it's a little bit outside my normal, kind of really bad business with a ton of leverage. The problem is it was a very good business, but it could potentially be a stranded asset, right? So there's a huge inflection happening in the business where they used to print money, but they've kind of been disintermediated, and they have the customer concentration issue, and the global export market for thermal coal blew up. So I really like it because I think the estimates are 50-60% too high. I think there is a chance this asset is almost stranded, and they need to repurpose it for something like lumber, in which case the stock could go down 70%. I'm not going to go through it too detailed because my blog, to give you the basics, this is a very high quality coal terminal on the west coast of Canada, just outside Vancouver. They basically had a monopoly on exporting coal for a huge amount of coal coming out of Wyoming, and obviously Teck Resources, which is a big Canadian coal company, exported all their coal through there. So the problem was, as you mentioned, customer concentration first and foremost. So Teck is basically 2/3 of their volumes. Now Teck was paying way above market because they're a captive customer. They're a captive customer because until very recently there was no other place to export the coal from, and so they had to take the price that West Shore named. But that contract ends in 2021, in March 2021. And, Teck said, we've had enough, and they're actually building their own terminal. Well, there was a terminal existing, and they're expanding it. And also, there is an existing terminal called Ridley, which was owned by the regional government that got sold to private equity owners, and is therefore open for business and needs to fill capacity. So the market balance has completely changed. And so basically what's happened over the last, say, 6-9 months is Teck has committed a lot of capital to finish their terminal. And they signed rail agreements with Canada National, I should say, to build the rail infrastructure necessary to ship coal to the other terminal, which is called Neptune. So look, whichever way you slice it, the volumes are going to go down at West Shore. So the argument for the bull case would be, volumes will go down, but they're still likely to ship some coal through West Shore because Neptune's not going to ramp up immediately, and even if it ramps up, there's probably a few million tons of coal that needs to be sent through West Shore, and maybe they can make it up on lower volumes, like charge higher prices. The problem with that argument is the decremental margins are so terrible because this is almost a completely fixed cost business, right? So if you think about it, you build the coal terminal, you employ a certain amount of people, and if you throughput 35 million tons, or if you throughput 20 million tons, the costs are almost the same, right? It's not like they don't rely on part-time labor, right, in Canada. So the labor costs, and you can look at this in the P&L, the labor expenses is been going up every year, whether they ship 30 million tons or 20 million tons, right? So, it's an almost full fixed cost business. So the problem is, Teck right now is 18, 19 million tons. That's going to go below 10, right? Maybe it'll go to 5, maybe it'll go to 10. Either way, the decremental EBITDA margin on those lost 10 million tons could be very large. It could be as much as $8 or $9 per ton, Canadian dollars per ton. Now, given that they did over 200 million of EBITDA last year, you can see how massively impactful that would be. You don't have to be, you could give back some of the value on the remaining tons and still have earnings much, much lower. Now, that's a problem in and of itself, but compounding the problem is the fact that the other third of their business, actually more than a third, probably 40% from next year, is thermal coal export. Thermal coal export market is almost all Asia, and the Asian thermal coal export market, the substitution fuel is natural gas. And guess what's happened to natural gas? It's been obliterated. Natural gas has been obliterated because a huge amount more is being exported from the US that didn't happen a few years ago, and also there's just too much gas, right? It's a byproduct from shale. We all know that. So when your competing fuel is so much cheaper, who's going to burn coal when they can burn cleaner natural gas? The other reason is Indonesia removed the export bans that they had put in place on thermal coal because they want to capture the market, right? Essentially, they're the low-cost producer, and they decided to flood the Asian market with their thermal coal, which is displacing North American thermal coal. So a number of Westshore's customers went bankrupt, right? So Cloud Peak, which was meant to be almost 30% of their volumes in 2021, went bankrupt. So it's completely unclear if they're even in the market in a few years. Right now, it seems like they're still shipping, but the people who bought Cloud Peak are the Indian nation, the Navajo Nation. They're not exactly cash rich. Without going into too many details, it's very unclear if they have the money to allow Cloud Peak's mines to stay operating. And most of all the other clients of Westshore, they're not all thermal coal. Maybe there's the odd met coal guy in there, but a lot of it is thermal coal. So, look, Teck is going to leave. That's going to destroy margins. And then a lot of the other guys are, at the moment they're basically they're not price takers, they're price makers because they're so distressed. Unless Westshore caves on pricing, they just won't ship, right? They just might disappear. Or they'll disappear anyway. And that actually showed up in the last guidance from Westshore, where they recommitted to delivery volumes for believe it was for 2020. I have to double check. But they cut pricing. So they're already giving back on pricing. And of course, when 2021 rolls around, Teck is going to, I think, largely disappear. So the question for Westshore now is, look, the stock 18.5, it trades around 10 times earnings this year. But I have it close to 20 times earnings. And I think earnings from 2021 look much more like steady state earnings. So what would you pay for no longer the only export terminal for coal on the West Coast, but one of three, where the vast majority of your clients are swing producers in the global thermal market, as opposed to through the cycle met coal producer, which is Teck, where your basically your customer base is extremely high credit risk all the time. I don't think 20 times earnings is the right price for that, right? I could be wrong on my earnings numbers a bit. Maybe they protect a little bit more value. I don't think 15 times is the right number for that. Look where coal equities trade, right? This is a much better business than a lot of coal equities, obviously, and there's no debt. But coal equities trade at 3 times cash flow. A lot of these things, 4 times cash flow, 5 times cash flow. So one way to do it is you could buy a higher quality met coal name, which I actually own a couple of met coal names, which trade at very attractive multiples of free cash flow, and short this as kind of like not a pair, but almost a pair, right? So if coal really bounces back, or if met coal supplants thermal in terms of volume throughput at Westshore, Westshore stock will maybe it'll go up a bit, maybe it'll hold a higher multiple. But my coal equities trading at 5 times free cash flow could double. In the other case, if coal goes down together and gas completely takes over on the thermal side, and met coal goes through a bear market, well, guess what? This thing could get cut in half and then some. And what I like about this is the company used to aggressively buy back stock basically every quarter the last 2 years. They actually stopped buying back stock last quarter, maybe the last 2 quarters, which look, they still pay a bit of a dividend, but that tells me they're worried. They're trying to build a cash cushion. So I think, look, going into 2021, they're on the clock, right? So at some point, they're going to have to announce what's happening with Teck. That could be a huge catalyst. That'll happen sometime in the next 6 to 9 months. Or if things really hit the fan, one of their other customers may go bankrupt, or Cloud Peak could say they're going to stop exporting completely. That could happen. Or, they could come out and say we're going to repurpose part of the terminal for lumber. Huge negative catalyst, very expensive. So there's a few things that could happen. It's kind of a sleepy security. It's only a $1.5 billion market cap, not heavily shorted, no debt on the business, which obviously I don't like, but it's kind of a bit of an oddball situation. I like that one.
So why is it up? Do you have any idea? Like, is it just because not many people are aware, or
it's not up? It's still
why it's holding
down.
up? Let's say.
Yeah. It's just down a lot less than all the other coal names, right? It should have traded much closer to the other coal names. The reason it isn't is because it's a Canadian equity largely owned for dividend by dividend players, and 25% of it is owned by a very rich Canadian who's well respected, and I think a lot of people just follow what he does. But the thing is, he's been a majority owner for a very long time, and my point is the business is inflected. This was an excellent asset that is now very much a potentially impaired asset, and the business quality chain. And again, it's optically cheap, right? It trades at 10 times earnings, has a 3.5% div, almost a 4% div. So optically, it's cheap. there's no debt. Canadians care about divs. That's all they care about. I don't. And look, there's no one really looking at it. I don't think there's maybe one or two Canadian guys cover it, but not a lot. Yeah. So look, it's not. This isn't my largest short. This isn't a huge conviction short, but I do think there's a good chance that earnings get remarked. A good deal lower, 50% lower. And this could be a stranded asset in the worst case outcome. And as I said, I'm long one or two coal names, which are extremely cheap. So in any kind of bullish coal scenario, yeah, this could definitely go up, but there's no way it could go up as much as some of those coal names.
Fair enough. No, I found it really interesting. So great further insights, and I'll certainly keep an eye on Westshore. Now we're kind of closing in on the interview. I just have two last questions.
Okay.
If you don't have anything else to add, my first question is, what would you do differently if you had to start all over? Is there one thing that when you look back at your short selling, you would say, oh, I would do it much earlier, or I wouldn't do it at all? Was there something like that?
I mean, I would probably try and spend a lot more time thinking about sizing of these positions, right? So the trick is the sizing, right? Getting them right or getting them wrong. I back myself to get them more right than wrong. Obviously, you don't get them all right. I back myself to get them more right than wrong. But sizing is really the make or break for shorting. I mean, it's just paramount. There's almost you can't spend too much time thinking about sizing. And I mean, I back myself, and sometimes I kind of get a bit too gung-ho and go into these things. So if I had to start over again, I would probably sit down and kind of run a model portfolio at different sizes for a long period of time, trying to figure out what the optimum size for a short is. Like maybe I kind of figured out you don't want to be more than 4 or 5% of NAV in any short at any time, no matter what. But it took me a lot of experimenting and a lot of losses to get there, let's say, or a lot of opportunity costs to get there even. So that's definitely one thing I would do.
That's I think a great reminder of what one needs to look at very diligently, for sure. And the last question that I have is, what is the one thing that you believe is essential or truth when it comes to investing or short selling, but only few people actually agree with you?
I don't know. I mean, that's a tricky one. I'm not sure I think about it in those terms. Yeah, I mean, look, I think this, in this kind of market environment, right? I'm not sure everyone thinks this, but there's a huge amount of enthusiasm in the market, right? A lot of people think shorting is evil, or that you can't make money shorting because the market always goes up, or a bit of both. Look, there was an op-ed in the FT recently from a guy on the board of Baillie Gifford, who basically called shorting evil. He's clearly talking his own book there. I'm not sure Baillie Gifford, I'm pretty sure, is a long-only shop. The GPIF, the Government Pension Fund of Japan, said they're not going to lend out their stock to short sellers because they basically don't believe in the function of shorting. I mean, this is the kind of stuff you see near the market top, right? That shorting is evil, you can't keep stocks down, why are you betting against the market? That's immoral. I mean, look, so I don't want to say everyone believes this, so I'm the only guy that doesn't, but
I think listeners of this podcast probably are with you.
I mean, it's kind of important to an accurate functioning of the market, right? Like if there were more short sellers back in 2000, maybe all the people who lost their shirts in the internet bubble wouldn't have lost their shirts, right? It's kind of the hypothetical of all hypotheticals, right? It's not really measurable or testable, right? You could have just had a lot of short guys carry it out, and the bubble went to another high. So it's hard to measure. So I'm not sure I would think of it necessarily in those terms. I would just think of, I'm a big believer in focusing on your strict methodology, your own style, and not straying from that, right? So while I'm a generalist in the sense that I look at a lot of different general sectors, my methodology is pretty ironclad the way I look at ideas on the long and the short side. So, I do think there's a huge value in that. I know it's not really an answer to your question, but that's kind of my one fundamental to leave it with your listeners would be to, I don't want to say find your edge and stick with it, because what is an edge, right? An edge is just applying the tools that a lot of people apply them and do it a bit better, right? Just, doing your analytical work a little bit better than the guy next to you. Just like the best plumber has the same tools as other plumbers, the best surgeon has the same tools, the same training as other surgeons, but why is he the best? He just executes a little bit better than the next guy. So not find your edge and pursue it, but definitely focus on what you have proven to work for you.
Yeah, sure. No, I think
don't stray beyond that no matter what. It's always a recipe for getting yourself into trouble. That probably goes for life, maybe as much as investing. I don't know. But,
sure, no.
That's where I am with it anyway.
Sure, no, that's a great point. And I think on that note, I would like to thank you, Jeremy, again for coming on the show. I hope you enjoyed it as much as me. I really appreciate you accepting the invite, and thanks a lot for doing the interview.
Thanks, Jan. And just in case anyone is interested in reading up on some of the stuff we talked about, they can follow my blog at www.rapercapital.com. Thank you.
That is it for our interview with Jeremy. If you're interested in something we talked about, do not hesitate to check out the description of the episode. There are tickers of the companies we mentioned, as well as Jeremy's blog. Lastly, do not forget to subscribe to the podcast. There will be new interviews coming soon. Thanks a lot for listening.